Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Today's Analyze Out Loud video is going to take a look at Costco. The stock has had a correction since about May of this year, and a lot of people were expressing opinions about whether or not it's fairly valued or not. With this video, I'm going to take a look at Costco's valuation historically, and I'm also going to look at how forecasting indicates valuation at today's level. I'm going to start out by taking a look at Costco's long-term operating performance based on adjusted operating earnings going back to 1998. And as you can see, the company's grown earnings at 10.7%, and they've done it rather consistently, a couple of hiccups along the way. But what's really interesting is a couple other things I want to point out. This company has only been paying a dividend since 2004, but they've grown their dividend quite well. So when you look at their payout ratio, it's relatively low, and that gives them room to increase it. Their current yield is 1.3%. Their blended PE ratio right now is 27.2. Their A+ rated and only have 19% of debt. But what's really interesting about the Costco story is how the market has priced this stock. This blue line I'm drawing on the graph is a normal PE of 23.9. Now that's just a reference. In other words, it gives me a perspective to look at how the market has historically valued this stock. And when I bring monthly closing stock prices onto the graph, the first thing that really strikes me is the market has consistently applied a very high valuation. A 24 PE ratio, if you will, is a very high valuation for a company growing at 10.7% a year with a moderate dividend yield that's only been paying one since '04. But here's the point. I don't argue with this, I analyze it. In other words, it's very clear looking at this long-term historical record that if you wanted to own Costco, you had to be willing to pay up for the stock. However, I think it's also important to realize that this has been a pretty consistent valuation reference, and in more recent times, the PEs have gotten even higher. And as I pointed out, it's currently at a blended PE of 27.2. Now, a couple other things I want to do is I want to shorten the time frames. So I'm going to drop this to 2005 to current. We see the growth rate still 9.4%. Our normal PE valuation reference has changed a little bit to 23, but it's still essentially the same valuation reference. In other words, I would say this stock has historically commanded a 23 to maybe a 25 PE ratio. But even after this correction that we've seen since May 31st of 2017, on this basis, Costco still looks like it's trading at a very high valuation. And I think that's an important consideration. Are you willing to pay these high valuations to buy this stock? Now, a couple other metrics I want to look at. I want to look at diluted earnings, or commonly known as GAAP. Some investors prefer GAAP, and I get a very similar picture here. A premium valuation. Only during the Great Recession did this company get close to a 15 PE ratio, which would be theoretically a fair value for a stock that has this type of historical record. But let's move on to operating cash flows, because that's another way to value a stock, especially a dividend-paying stock. And I'm essentially looking at it from the perspective of since they've been paying a dividend. Now, what's interesting is that their dividend has increased every year, and it's obviously very well covered by operating cash flows. The company did have a drop in operating cash flows for fiscal year ending August 31st, 2016, but they announced in their financial report that that was because they made significant prepayments to vendors, so that temporarily reduced their cash flow. You see it's recovered very nicely going into this fiscal year, which ends August 31st, or just a few days ago. So Costco, if you look at it from a standpoint of operating cash flows, valuation looks a little more reasonable. And then if I go on and look at EBITDA, earnings before interest, taxes, depreciation, and amortization, I get a picture very similar to the operating earnings. The company has traded at normally at about an 11 times EBITDA. It's currently trading at 13 or 12.8 times EBITDA, which would indicate essentially some overvaluation. But let's look at what that would mean going forward in terms of what rates of return you might be able to. So in order to do that, I'm going to take a look at the forecasting calculator. And again, this is a pretty widely followed company. There are a lot of analysts, 18 to 20, that are reporting on this company. The number of analysts kind of drops off the further out you go. But regardless, there are 18 analysts forecasting Costco to grow at about 9.17% for this fiscal year, which just ended, a few days ago. They won't report for another month and a half or so. And then there are another 19 analysts forecasting about 8.65, followed by 10 analysts reporting 8.9. So we've got about an 8.7% growth rate which is reasonably consistent with what the company has historically achieved. And of course, they're getting big. They're a $68.7 billion company now. But if I applied this normal valuation to this stock, by year end next year, there could actually still be a negative rate of return if it traded at its normal 11.1 times EBITDA. If you go out to the end of 2019, the rate of return would be about 2.75%. And if you went out to fiscal year end 2020, it would be about 5%. So the point is, the company is still expected to grow pretty nicely, but the problem is, even with forecasts continuing at roughly the same rate the company's achieved historically, this high valuation doesn't give you much room to make any money. Even if it trades at that 12 to 13 PE or price to EBITDA ratio, your rate of return will be somewhere between 8 and 11% out to 2020. So the real question is, how much risk are you willing to take with this company? When I examined the analyst scorecard on price to EBITDA, I do discover that the analysts have been pretty accurate with their 1 and 2 year forward estimates. So if you're looking 1 to 2 years out, there's some credence that these estimates may be within a reasonable range of accuracy. And all in all, it would still indicate that the company is probably moderately overvalued. Now, what I'm really looking at here is simply a look at this company from a historical valuation level. It's very clear the market puts a high premium on this stock to earnings, but how big a premium are you willing to accept? The valuations have gotten even higher than historical norms in recent years, and of course that's created quite a bit of volatility, as you can see just by looking at these price points for the last two and a half years or so. So I really like this company. I like it a lot. There's a lot of things about it that that would be attractive. However, what I don't really like today is the current valuation. On the other hand, let's go back and look at operating earnings here and look at valuation based on that. And I'm going to go to the forecasting calculator, and I'm going to utilize the normal PE ratio version. As previously stated, this company trades at around a 25 PE historically. So on that basis, there would be moderate rate of return, 8.5, 8.35 out to 2019, 9.48 if it traded at this 25 multiple. And it's interesting to review the historical normal PE ratios, and you can see that the market has very, very consistently applied something between 23-ish PEs on the low side, which would obviously mean that future rates of return would not be that great for the next couple of years. On the high side, the PE of 27.5, which is where we've been recently, would indicate that you could get double-digit rates of return. But the question you have to ask yourself is the market going to continue to value this stock at these very high premium PEs, or would it make more sense to go and use something in the middle like a 24 PE to make your expectation? I think this is a great company, and I think it would be a great company to invest in if you could buy it at a sound valuation. I think valuations today are a little high on that basis, but everyone needs to do their own due diligence and make their own decisions. There's a lot of articles, good articles written about this stock. So you can, go to sites like Seeking Alpha or Morningstar and get additional information. But the real key is you should be aware that valuation right now is a little higher than historical norms would typically support, even considering that the market likes to put a premium valuation. So the question at the end of the day is, how much risk are you willing to take to own a great stock like Costco? It's been Chuck Carnevale saying thanks for listening.